Hello and welcome to the Freddie Mac HFA Advantage and LPA overview. Before we get started, I would like to review a few housekeeping items. All attendee lines have been muted upon entry and will remain on mute to prevent interference. This call will be recorded and shared after today's call. If you have any questions or technical issues, please use the Q&A box in the right-hand corner of your screen. Without further ado, I'll pass it over to Karina. Karina, the floor is yours.
Thank you, Kiara. Good morning, everyone. And my name is Karina Obar, the manager of the Home Ownership Division here at the Washington State Housing Finance Commission. And we are very excited for this opportunity to partner with Freddie Mac in hosting this webinar and that all of you could join us. And a majority of our conventional loans have been Freddie Mac due to the fact that we've been great pricing with our Freddie Mac product. As you are aware, we offer the Freddie Mac options with down payment assistance and without down payment assistance. We have seen borrowers may have their own down payment and want to use the flexibility of our first mortgage. We've also seen scenarios where borrowers use their own funds and our funds for DPA just to bridge that gap, as well as using it for closing costs, and then use our funds for the down payment closing costs and their funds to fix up the property. And as you are probably aware, we offer permanent rate buy downs on our Home Advantage loans, and we do not have any overlays on debt to income ratios or credit scores. And also with our Freddie Mac product, we do not have any additional credit fees or loan level pricing adjustments for DTI or loan to value or things of that nature. So I know that David has a lot of information to cover today, so I will turn it over to David.
Thank you so much, Karina, and good morning, everyone. Thank you so much for joining us. We know that your time is very valuable, and so we're really excited to share this information with you. Along with me, I have one of our senior underwriters from the 1-800-FREDDIE call line, Susan Dyke, who will be joining us and will be available to answer any general questions that you may have. If you have specific scenario questions, we do ask that you go ahead and call our 1-800-FREDDIE line and talk directly to one of our underwriters. And so with that, we'll go ahead and get started. I will remind you that there is a Q&A option. So if you do have questions along the way, there's a box where you can go ahead and enter your questions, and we will get to as many as we can. And whatever we don't answer, we will get back to you after the webinar. So with that, I am going to go ahead and stop my video and get to the program here. So brief introduction about myself. My name is David Mendez. I'm an affordable lending manager with Freddie Mac. And in my role, I provide outreach and support to loan officers and operations staff and real estate agents who participate in our affordable lending programs, including the HFA Advantage program. You see my email on this presentation, which you will be getting a copy of. If you do have questions, please feel free to reach out to me. You can reach me on my email address, david_mendez@freddiemac.com. A little bit about Freddie Mac and who we are. So for those of you who are not familiar with Freddie Mac, we are one of the GSEs, one of the agencies as we're commonly referred to. So we don't actually originate any loans. We operate in the secondary market. We purchase loans from lenders like yourselves. We bundle those loans into loans with similar characteristics, and then we sell those loans on the secondary market. And we take that money that we sold those loans from and we purchase more loans. And so that's what we call liquidity. And that's how lenders are able to continue to make more and more loans without having to wait 30 years for those loans to get repaid. We were chartered by Congress in 1970. As I mentioned, we operate in the secondary market, and we're mission driven. Our mission is to promote liquidity, stability, and affordability in housing nationwide and in all economic conditions. We also have a community mission to stabilize communities, prevent foreclosures, expand credit responsibly, educate future home buyers, counsel homeowners, and support affordable rental housing. We have three main business lines, including single family, which handles 1 to 4 unit for sale properties, as well as a multifamily and a capital markets line of business as well. Housing finance agencies. So for more than 50 years, State housing finance agencies have played a central role in the nation's affordable housing system. State HFAs have delivered more than $600 billion in financing for the purchase, development, and rehabilitation of more than 8 million affordable homes and rental apartments. HFAs serve very low and middle income households, first-time home buyers, and other specialty segments with limited funds for down payment and closing costs. HFAs are a great opportunity for you to reach more potential borrowers through HFA programs that offer down payment assistance or preferential pricing. You heard Karina mention before, there's so many different ways to use these HFA programs. Even if the borrower has their own funds, you can still leverage either the down payment and get creative with the down payment assistance that's offered, or take advantage of below market rates. And you can just really get creative and really reach more borrowers that, but through these programs, might not be able to purchase a home. Most HFAs, like Washington's program, offer down payment assistance programs to further support borrower needs. And Freddie Mac HFA Advantage is a competitive alternative to FHA financing offered exclusively through HFAs. So Freddie Mac's HFA Advantage program is a first mortgage program. When you're doing the conventional program with Washington, you have your choice to choose Fannie or Freddie. If you choose Freddie, that first mortgage is going to be an HFA Advantage mortgage. We're going to talk a little bit more about those features and benefits in just a moment. So with the Freddie Mac HFA Advantage mortgage product, we do allow both 1 and 2 unit property, 1 or 2 unit primary residences with the Washington program. Allows for purchase and no cash out refinance. We allow for non-occupying borrowers. You can use this program for manufactured housing, flexible funding for down payment and closing costs. The HFA is the one who establishes the income limits, and that is what really separates this program from some of the other affordable programs such as Home Possible, which is limited to 80% of the area median income. With HFA Advantage, we defer to the agency, to Washington, to establish those income limits. This program is available to both first-time home buyers, repeat buyers, and borrowers seeking no cash out refinances. You would use Loan Product Advisor or LPA to underwrite these loans. Flexible mortgage insurance options are available. And one thing I'll mention about flexible MI, and I'll talk about MI in just a moment even greater, is that we allow for charter level mortgage insurance, which is a significant reduction in the borrower's monthly payment, or it would allow the borrower to purchase more home, because with a lower payment, you're lowering that debt ratio, which would then allow you to qualify for a higher loan amount. Additionally, there are no reserves required. However, they are recommended, and in many cases, that could be a compensating factor to help get the loan approved. Again, I'll remind you, if you have any questions, please feel free to pop those into the Q&A box. Moving on, why would you choose HFA Advantage over something like FHA? Well, what I'll say is we don't sell against FHA. In some cases, FHA may be the right or the best product for your borrower. High debt ratios, low credit scores come to mind, which is more ideal, generally speaking, for an FHA loan than a conventional loan. But with all things being equal, an HFA Advantage loan has certain advantages over the FHA product. The first one being, and probably the most important one, is that the mortgage insurance ends when the LTV is less than 80% versus FHA, where that mortgage insurance stays for the life of the loan. We also allow for custom level mortgage insurance, and it has a monthly premium versus FHA, which has an upfront and a monthly premium. For the conventional loan HFA Advantage, MI is only required if the LTV is 80% or higher. For FHA, MI is required regardless of what that LTV is. And again, on HFA Advantage, there is no upfront mortgage insurance premium, on FHA, that upfront mortgage insurance premium is usually added to principal and then amortized over 30 years. So with more funds applied towards the principal upfront, an HFA Advantage mortgage with PMI lets the borrower build equity faster. I mentioned charter level mortgage insurance before, and this is what it looks like. So the coverage requirement on a loan that's between 95 and 97% of the loan to value on an HFA Advantage loan is only 18% versus standard coverage at 35%. So the coverage requirement is almost half of the requirement of a standard mortgage. And so that doesn't equate to half of the MI payment, but it does equate to a significant reduction in that mortgage insurance payment, in some cases to the tune of hundreds of dollars a month. And so again, that will save your borrower those hundreds of dollars, allow them to either qualify for more home, or just make home ownership more affordable for them. Between 90 and 95, it's 16% coverage versus 30. Between 85 to 90, it's 12% coverage versus 25. And then between 80 and 85, it's 6% coverage versus 12. So again, all that to say, by using HFA Advantage, it's a significant reduction in that mortgage insurance premium payment. The value of affordable seconds, a subsidized secondary financing options for first lien mortgages. It can increase your originations for very low and low income borrowers. It provides the borrower with additional sources for down payment, closing costs, financing, and prepaid costs. And affordable seconds are eligible for HFA Advantage. So in addition to the assistance that you're getting from Washington, there may be some local programs as well that you can tack on and put them in, for instance, third lien position to really help your borrower purchase that home, or really just make it more affordable. And so I'll pause here to mention also that Freddie Mac recently rolled out a new website called DPA One. And DPA One is a repository of all of the state housing finance agencies across the country, and then local housing finance agencies for many of the states within the country. Now, Washington is not on there at the moment, but our goal is to have all 50 states, state and local programs in the database by the end of the year. So that's DPA One. The best way to find it is simply to Google DPA One. The actual website is dpa1.freddiemac.com. And again, that'll allow you to find state housing agency programs as well as local housing finance agency programs. It will also allow you to do a side-by-side comparison. So you could look at two of Washington's state programs and compare them side by side to see which one might be the better option for your borrower. It allows you to then send that DPA information to your borrower by simply clicking in a box, and it'll allow you to email them, hey, this is a great program, you might want to consider it. So again, the name of that program is DPA One. The website is dpa1.freddiemac.com, or simply Google DPA One and it'll pop up towards the top of the list. Moving on, I mentioned that Loan Product Advisor is the automated underwriting system that you would use to underwrite your loan, also more commonly known as LPA. When you're using LPA, you want to make sure that you select HFA Advantage in the offering identifier field within the mortgage type and loan term sections of LPA. If you're using an LOS system, please contact them to verify the field and value to enter. Some LOS systems don't actually list the name HFA Advantage. Instead, they use a code. The code will always be 251. So again, you want to look for HFA Advantage or code 251. And you'd be surprised at how many times that we see loans come across being sold to Freddie Mac that were intended to be HFA Advantage mortgages. And for some reason along the line, either the loan officer chose the right program, HFA Advantage, and accidentally changed it along the way, or maybe a processor changed it. But you want to make sure, even at closing, that it's still listed as HFA Advantage, because it is very common that along the lines that program is accidentally changed to something else. The best way to verify that the loan was submitted correctly is to check the feedback certificate. You can verify the loan was submitted correctly by ensuring the value entered in the offering identifier field is showing HFA Advantage. This is found in the mortgage information section of LPA feedback. So if you look in the lower left-hand corner of the screen here, you'll see offering identifier. And again, you just want to make sure it says HFA Advantage. It sounds kind of obvious, but again, we get so many loans where accidentally the loan product was changed at some point and never changed back into the correct program. When you're using down payment assistance, we have, this is how you would enter an amortizing subordinate financing loan. It would ask you for the creditor name, the creditor type is business, lien type is second lien. It will ask you to enter the monthly payment because this is an amortizing subordinate loan. It will ask you for the loan type. It will ask you, is the other new mortgage an affordable second? It's going to be yes. Is the affordable second payment deferred? In this example, it would be no, because it's an amortizing subordinate loan. It will be no for HELOC, and then the funding source will be local agency. We also have an example of how to enter a non-amortizing subordinate financing loan. Very similar input. Lien type is still going to be second. In this case, the monthly payment is going to be 0. Again, you'll enter the loan amount. Is the other new mortgage an affordable second? Yes. Is the affordable second payment deferred? In this case, it's going to be yes, and that's going to trigger the system not to count the monthly payment. It is not a HELOC, and the funding source is local agency. One thing to mention, if the affordable second doesn't have a payment before the 61st month under the first lien mortgage, the monthly payment and initial principal and interest payment must be equal to 0. So again, if there is no payment within the first 5 years, you're going to put 0 in the monthly payment, and that's going to count as a non-amortizing subordinate loan. If on the 61st month there is a payment, again, that's still going to be 0. Let me see, there are no questions. We're going to continue. Mortgage details. In the mortgage details section of the feedback certificate, you're just going to want to make sure that your second mortgage is there. In this case, we see it's an affordable second, and it counts as secondary financing. This is the same loan. It's just saying that you do have secondary financing, and that secondary financing is an affordable second. We'll also see that the reserves are located in this corner, and we'll take a look at that in a moment as well. Purchase eligibility in AUS risk class. Upon successful submission of an HFA Advantage mortgage, the following results are returned. The assessment summary section of the LPA feedback certificate displays the purchase eligibility and risk class results for the transaction. So what you're looking for is you want to see that you have an eligible and an accept. The risk class accept warrant relief for credit, reputation, and ratios. A caution means no rep and warranty relief. So here under purchase eligibility, and we'll take a deeper dive, what this is talking about is the loan product, not the borrower. And so they want to make sure, or we want to make sure, that the way you put the loan together is in compliance with how the loan product allows. So for instance, if the LTV is max is 97% and you go to 98, then this is where you would not get the eligible. It has nothing to do with the borrower's credit worthiness. That comes under risk class. So let's take a deeper dive into both of those classes here. In this case, in this example, the purchase eligibility was ineligible. again, has nothing to do with the borrower's credit worthiness. This is just saying that the way you put the loan together is not eligible under that particular program. In this case, it says the TLTV ratio of 98% must be equal or less than 97% for this example. And the LTV is 98%, which must be equal to 97%. And then the loan was submitted with a debt ratio of 52, which exceeds the maximum allowable limit, again, in this example. This is just an example. So again, the reason why this loan did not get the eligible under purchase eligibility has nothing to do with the borrower's creditworthiness. It's because you went over the LTV and TLTV and the allowable debt ratio on this particular loan. So those are reasons why you would get an ineligible. Moving on to the borrower's risk class. In this example, the loan officer put the loan together. Everything was according to guidelines, but the borrower received a risk class of caution. And so these are some of the reasons why they would receive a caution. Now, I will say that this slide is slightly outdated because we did go through LPA and update the feedback findings based on feedback from you out there in the field. So a lot of times when we speak to loan officers and ask them, why they would use DU over LPA, one of the most common responses is because of the feedback certificate and because it's easier to tell what needs to be changed on DU versus LPA, or at least that's how it was in the past. So we've recently updated LPA to make those feedback findings more clear so that you can clearly understand why this borrower did not get the approval that you were looking for. A lot of times we'll have loan officers, they have what they believe is a good loan. They don't know why, they did not get the approval that they were looking for. And so in cases like those where you think you have a good loan and you don't understand why that loan is not getting approved, you can call our 1-800-FREDDIE line and speak to an underwriter like our senior underwriter, Susan, who's on the line today, and talk to them and ask them and say, hey, I ran LPA and for whatever reason, I'm not getting the approval that I think I should be getting. Can you help me understand this feedback certificate? And the underwriters will be happy to walk you through that. But these are some of the more common reasons why you would get a caution. Analysis of credit history is recommended. A lot of times what we're looking for is 3 trade lines that are aged at least 24 months is usually what we're looking for. So some of the time, the borrower just doesn't have that. They might have the 3 trade lines, but they don't have the 24-month history. Debt ratios, those are pretty common. LTV. So in this case, we see the eligible. So we know that the borrower is within the guidelines. We have a max LTV of 97% for HFA Advantage. And the borrower, was at 97. So, they're within guidelines. But because of their credit profile, even though the program allows you to go to 97, reconfiguring the loan to get a lower LTV might help that borrower get approval. So even they're within guidelines, because of their credit profile, lowering that LTV might help. This one's pretty obvious, but number of inquiries could negatively affect the borrower's approval. Most loan officers nowadays coach their borrowers not to run their credit during this process because something like this might pop up. We know that borrowers get very excited. They want to start buying furniture and appliances. And, it's not uncommon for them to go get credit cards or, Best Buy, Home Depot. And so if you're not already coaching your borrowers not to run their credit, it would certainly be a good idea because this is a common reason why loans don't get approved. It's just because they have a lot of inquiries combined with other factors, their credit profile. So they might be on the lower end with their credit score or pushing the debt ratios. So by itself, it may not be a deal breaker, but when you have other factors that's when number of inquiries could negatively affect that borrower. So I'll take the time now to mention something that we call layered risk. So any one of these may not be a deal breaker by themselves, but when you start layering these different risk factors, that's when you have a higher chance of getting that caution. So you're pushing the LTV to 97, you're pushing the debt ratios, the borrower is within credit score, within the minimum credit score, but it's on the lower end. Now they have a bunch of inquiries. Those are all separate layers. So any one of those by itself, probably not a big deal, but now they have 4 different layers of risk. That's when you start triggering those cautions. So something to keep in mind. Lack of recently reported balances on revolving open accounts. That one is kind of counterintuitive. You would think, okay, so they don't have any balances on their account. Why is that hurting them? But what we're really looking for is that we want to be able to prove that the borrower can manage debt. So if they have a bunch of open accounts and they're all zeroed out, that doesn't necessarily mean that they know how to manage the debt. When they purchase the home and say they max out or run up these open accounts, they may be struggling and get in over their heads. So sometimes we're looking for those revolving accounts to have maybe be on the lower end of having balances or showing that they used the credit and then paid it off. So looking for really, again, just to know that the borrower can manage the debt, not just have an open account with a 0 and then max it out later and get in trouble. Because ultimately what we want is we want this borrower to be able to purchase their home and keep it. Number of accounts open within the last 12 months, pretty obvious. And then number of accounts with balances. So kind of the opposite of, lack of balances. It's pretty obvious if the borrower has a bunch of accounts with balances, particularly high balances, that could work against, the borrower as well. Okay, moving on. And again, I'll remind you, we do have that Q&A box. So if you have any questions, we're very fortunate to have one of our senior underwriters on the call today. So please feel free to send in your questions through the Q&A box. The mortgage details section of the LPA feedback certificates displays HFA in the offering identifier field, the affordable second loan amount in the affordable second field, and the total subordinate financing in the secondary summary field. So this is actually a duplicate slide that snuck its way in here. This is similar to one we already saw. Again, we want to make sure that HFA Advantage is the offering identifier, and then we want to make sure that secondary financing and affordable second is also on the is being represented on the feedback certificate. And then we also see that reserves. So while the program doesn't require reserves unless LPA determines borrower reserves are necessary to offset other underwriting factors. However, because the borrower's reserves are a compensating factor, it is advisable to verify and include borrower reserves in the assessment. So sometimes having reserves can be the difference between getting the loan approved and not getting approved. And so sometimes you can be creative if the borrower has their own funds and you're getting DPA, maybe they don't use their own funds, for part of that down payment. Instead, they keep it in reserves and use the DPA funds for that down payment. So really it's up to the loan officer to be creative, but all that to say, reserves can be a compensating factor and quite often are. A lot of times we'll have, loan officers speak to our 1-800-FREDDIE line. The underwriter will recommend bumping up the reserves if they can. And, a lot of times that's the difference between getting that approval and not approval. I do see a couple questions. I'll pause and see what is the income limit on this product. So we defer to, again, Washington State Housing to determine those income limits. Those income limits are posted on their website. So I don't know, Karina, if you want to add anything to that, but we defer to Washington for those income limits.
Sure, thanks, David. So for our program, the income limit is $180,000.
So as you can see, that's pretty significant, and that really allows, quite a few borrowers to be able to qualify for this product. So if you think about it, you have a borrower or a household that makes $180,000, and they're still able to purchase a home with 3% down payment, potentially get down payment assistance, have a loan with no LLPAs or credit fees in price, take advantage of the charter level mortgage insurance. If you think about, who your borrowers are and who's in your pipeline, this is a fantastic product that really has a far reach. And so again, keep in mind this product when you're thinking about, the borrowers in your pipeline or future borrowers. Can you give us information on how to call Freddie when we have LPA findings, when we need help? Very easy. It's 1-800-FREDDIE. And then if you'll select option 2, that'll take you to an underwriter, again, like Susan, who's on the call today. So again, I'll remind you, that's just 1-800-FREDDIE, FREDDIE, and that'll get you to our 1-800-FREDDIE line. And again, you can talk about the feedback certificate or certain underwriting questions, even potentially scenarios. And Susan, did you have something to add?
I was just going to say for, LPA issues like data entry and things like that, they would actually press option number 3 for the LPA team, or if they're getting error messages and things like that, we actually have an LPA team that can help with the data entry on Loan Product Advisor. And also if they happen to get error messages, the underwriting team does not handle those. Those would go directly to the LPA team, and then underwriting team handles, questions, scenario questions, and, things like that, questions on the guide and so forth. Okay, just to clarify.
Yeah, thank you so much, Susan. So again, if you're having problems with LPAs, finding as far as technical issues or logging in or passwords, that's different. But if you have questions about the LPA feedback certificate and, as I mentioned before, why you didn't get the approval you thought you had, or again, as Susan mentioned, scenarios. If you have some scenarios, give us a call. We'll help you through those as well. Again, that's 1-800-FREDDIE. Okay, moving
Yes,
on.
absolutely. Always happy to help.
And they're easy to reach. Generally speaking, when you call, you'll get them, on the first or second ring. So, we're very fortunate, and it's a very underutilized service that, I'm surprised we don't get more calls than we do. A lot of times loan officers are just not familiar. So that's why we're here spreading the word, 1-800-FREDDIE. So moving on, in the feedback certificate, Loan Product Advisor, the message specific to affordable lending display in the message summary section in the affordable lending and access to credit messages section. This is a dynamic section that will only appear if it applies. Review the messages returned. So in this case, based on the property address that was submitted, it's going to give you certain feedback. So it's going to say based on the annual qualifying income, $51,600. So that's the income you submitted that you qualified the loan for. And the area median income of $65,600. Again, so it knows the AMI based on the property address where the property is located. This loan meets housing goal qualifications for LIP, low income purchase, since the income is at or below 80% AMI. So what it's doing here is it's just letting you know that this loan is at or below 80% of the area median income. But again, I'll remind you that Washington sets the income limits. You heard Karina, $180,000. So those are the income limits for the program. This is just providing you a breakdown, letting you know where the borrower's income falls within the AMI level. Again, here it's telling you the AMI for the property address is $65,600. But again, you'll default to Washington for those income limits for this program. Affordable seconds, it's just telling you that there's an affordable second that you triggered. Document the mortgage file with a note or other evidence of terms, closing disclosure statement, or alternative required by law. The evidence is the fees and costs paid by the borrower at closing in connection with a new affordable second, and evidence of subordination of an existing affordable second for refinancing. Really, it's just telling you you have an affordable second make sure you submit the required document. Next one, it says at least one borrower must participate in a home ownership education program that meets the national industry standards for home ownership education and counseling, or is provided by the HFA. In this case, it is a HUD-approved counseling agency or mortgage insurance, or Freddie Mac's Credit Smart Homebuyer U program. In this case, Washington does have a home ownership education program. Karina, I don't know if you want to speak to that a little bit before I move on.
Well, thanks, David. Yes, so for our programs, we do have our own home buyer education course that is co-instructed by our lenders and real estate professionals. And then, of course, we do have the online, which is the home buyer education course. That's a self-study through eHome America.
Okay. Moving on, only Freddie Mac seller servicers. We'll just skip that one because it's really not relevant. And so that's it for this one. I do see a question, and it looks like some of them were answered, but I thought I saw. If a borrower has a down payment, for example, 20% or more, can the borrower use the HFA program to cover closing costs? Yes, I'll defer to Karina, but absolutely.
Oh, absolutely. If you have a borrower that has their own down payment, but they need monies for closing costs, they can use our down payment assistance with the HFA Advantage on Home Advantage. So absolutely.
And I'll also mention, and I believe Karina mentioned that earlier, even if they don't need the down payment assistance, you could still leverage this program for all the other benefits, the reduced mortgage insurance, generally speaking, a more competitive interest rate. So those are other reasons why you would want to use this program, even if you have 20% down.
Yes, good point, David. Thank you.
Mm-hmm. Okay, moving on. Well, there's one more question here about the $500 credit. I've heard that if they take a class, borrower gets a $500 credit. That I'm not familiar with. I don't know, Karina, if that's a Washington program, but I'm not familiar with that.
No, it's not part of our program, David, so I'm not familiar with that.
Okay.
Yeah, I can't say that I am either. I'm not sure what that person is referring to.
Okay.
Um,
But Jamie, if you do have more information on that, feel free to email me and I can look into that and clarify it for you.
The next question was on the bond certification course. I'm not sure, is
Sure.
that a Washington program?
Right. So for our programs, all borrowers on the note and deed of trust are required to attend a commission-sponsored home buyer education course before reserving the loan in our system.
Okay, great. Okay, I'll move on to the next section here. This is the MI specific messaging. As I mentioned, it does have charter level mortgage insurance. One thing I didn't mention is that's when the borrower's income is less than or equal to 80% of the area median income, and 35% mortgage when the borrower's income is greater than 80% of the area median income. So this mortgage insurance is just going to break down for you what the coverage requirement is for your particular loan. And then additional resources. So we do have an HFA Advantage web page, and that produces or provides you with the latest and product information at your fingertips. It has product overview and fact sheet, convenient links to the HFA Resource Center, and other product related articles and materials. So this is what that looks like. Again, I would encourage you to go there. You will get a copy of this, so it does have a live link. You can click on that. You can also just Google HFA Advantage. It'll pop up then as well. Next steps in connecting with HFAs. Again, my name is David Mendez. I cover all the HFA programs in the West, and that counts really everything west of Missouri. If you have any questions, some of you may do work on other states outside of Washington as well. We are accessible. That is one thing that really separates Freddie Mac from our competition, you can reach us. You can call our underwriters. You can reach out to me. This is my email address. You can also call me. This is my phone number. You can even text me. Although one thing I would mention, whether you're texting me or emailing me, do not send any confidential information. Don't send me a copy of the feedback certificate. We can pull it up on our side. We don't want you to get in trouble. A lot of lenders, you'll get in very big trouble if you send that kind of information out. We don't want you to do that. We don't want you to be at risk. So please don't send me any borrower private information. Reach out to me. We can look it up on our end, but we are highly accessible. Email me, text me, give me a call. If you have underwriting questions, call our 1-800-FREDDIE line. We are super accessible and we're here and we're happy to help. We're happy to make home possible for more borrowers. And with that, I'll pause because we do have several questions coming in. I appreciate the questions. Keep them coming. If we have 2 or more, okay, I think we answered that. Let's see.
Yeah, and one of the questions, I was just trying to go through all these here. It's talking, somebody named Dan Caro, it looks like, asked a question about an ACE waiver. So yes, loan product advisor could possibly issue an ACE waiver, and as long as the housing authority has no objections against accepting an ACE waiver is an automated collateral evaluation that is used in lieu of an actual appraisal. So if the Washington Housing has no objections to that, then if you happen to get the ACE waiver in Loan Product Advisor, then yes, you should be able to use that.
So Susan and David, just to piggyback off of Dan's question, we will support the appraisal waiver on our Home Advantage program, provided that it is whatever it said in the AUS. We will go with that as well for the Home Advantage program.
And we also have another section in our guides. And let me, the way to get to our guide chapters would just be guide.freddiemac.com. And we have a chapter on the ACE waivers, and it's going to be chapter 5602.3. What you can do if you go out to the website guide.freddiemac.com, you can just put that chapter number in the search box and that will pop up showing you for ACE waivers. Now there are some ineligible things for ACE waivers, like for example, if it's a non-arm's length transaction, if it's something that's, a little out of the ordinary, perhaps like a leasehold estate or something of that sort, there may be some restrictions to using that ACE waiver, but the system, the Loan Product Advisor system, will make the determination on that. So Dan, I hope that answers your question. If you still had additional questions on it, I guess you can just call our 1-800 line and press option 2 for the underwriting team.
Okay, I do see one question. It says, when Freddie One comes out with Washington State, how can we sign up to be notified ASAP? Well, it's DPA One. And what I'll mention is we already have the State Housing Finance Agency in there. So even though we don't have the local information, we already have the state, and it's still a very useful tool for you to use to be able to do a side-by-side comparison of the Washington State program. So you can take a look and line them up, and will allow you to compare up to 3 programs at once. So I would recommend go ahead and sign up now. It's very easy to sign up. When you go to the link, it just says sign up. It'll ask you for very limited information, and you'll be able to get access. I saw one about interest rates here. Let's see. Where do we find interest rates for this product? Karina, do you want to take that one?
Sure. So for our programs, we do publish our interest rates on our website on a daily basis. So you can find our interest rates for our programs on our website.
Okay, this next one, I don't understand the question, but maybe you will, Karina. Did we calculate the 0% median income off of 180,000?
So is it the 80% of AMI? Is the 80%? Let's see what the question.
It says
0% median income of. So I'm not quite sure do we calculate the 0% median income off of 180?
Probably,
So in,
oh yeah, there it is. Sorry. Yeah, there's a
okay.
follow-up question. Yeah, 80.
Okay, so no, the 80% AMI is based on what Fannie and Freddie has determined what the 80% of area median income is for the conventional programs. So that is also posted on our website under our rate sheet on what the 80% AMI is for each county.
Okay, so hopefully that answers your question, Cynthia.
And I will also even add to that, that once you put the property address into Loan Product Advisor, it will also tell you what the maximum, median income is, like the 80% of the AMI. So it will tell you once you enter your loan into the Loan Product Advisor system.
Okay, perfect. And I believe that is all of the questions that we have, and that really wraps up our training, unless there are any other questions. Again, I would encourage you to look into HFA Advantage if you're not using it already. The rates are great. The features are fantastic, and we are highly accessible. We're here to help you. If you haven't done one, don't be scared. We're more than happy to walk you through the HFA, the underwriting portion of it. And, Washington is always there as well. And they're, super helpful as well to help you put those loans together. So please don't hesitate to reach out, and certainly don't hesitate to use these programs if you haven't used them before, because they're not hard at all.
So we also want to thank you, David, and your team at Freddie Mac for having this opportunity, and want to thank all of you for joining us. And if you have any questions on our programs, feel free to contact the commission as well. So David, thank you.
My
Thank you,
pleasure. Thank you for
Karina.
having me.
All right,
Thank you,
Susan.
Susan, for joining us as well.
Okay, you're welcome. Thank you, everyone.
Thanks,
All right.
everyone.
Thank you, everyone, for joining today's webinar. If we were unable to answer your questions live, we will have a member of our team follow up with you after the event. The recording of today's training will be made available. Thank you again for your attendance, and have a great day.